All right, so welcome to our little hangout here. We're going to do something that I think is really important. Do something that our desk traders are doing most every single day, which is sharing what's working. That's something that we have an advantage of on the desk in terms of seeing. Even though we're a small team, we still are seeing what's working with each other, and we can pick each other's brain on things that we're doing and whatnot to go about that and achieve that type of performance, find those trades, whatever the case may be. So that's something that you guys can also do within our community and whatnot, on a Skype chat, on a Discord, which is what we use on the desk. Um, Community is important. So however you find that, I think ours is great. If you're into Nadro or whatever, um, I know ours is great. But anyways, however you can find that, don't just go about your trading in total isolation. It's not going to make you stronger than you would be sharing information with others. So, real quick, I don't think I've ever done this before, so forgive me if I can't figure out how. I'm going to do a poll, and I'd like to know. So I just launched a poll. It's open. We'll close it here in a little bit. How much experience with futures do you have? I would like to read the room. I'd like to know kind of mostly who I'm speaking to, and whatnot. Couple more seconds. Votes still trickling in. Okay, let's end the poll. So some won, 59% with some experience with futures. We have 11% with very little or none, which is a little higher than I expected. So this will be a good little talk for you guys. And then the old crusty weathered veterans we have at 30%. Okay, thanks for doing that. Keep in mind also there is a chat. Obviously, a lot of you are using it, but along the way, if you have questions or whatnot, I may take them. I may hold them for the end. It just depends on the question, and if I feel like it's pertinent and something maybe that I missed that I should say right away, or it's something that we should go back and do. So with that said, let's talk a little bit about some benefits of futures and whatnot. One big deal that a lot of people, I think there's a misconception, is that they think futures, if I'm playing golf and someone says, "What do you do?" I usually say, "I'm a commodities trader," because people kind of understand what that is or whatnot. But what do they think? They think that I trade frozen concentrated orange juice like Eddie Murphy and Dan Aykroyd. They think that we trade, corn or soybeans, and they have a hard time really grasping, what trading futures and commodities really is about. Um, Guys, there's more volume that trades the E-mini S&P each day than all 500 stocks that are in the S&P 500 combined. So futures it's an asset class, technically. I don't know why I said it that way. Asset class. But the asset classes essentially you have access to is ridiculous, from fixed income to crypto to pure commodities like agricultural products, metals, energy products, which are asset classes within themselves, right? Sectors, if you will. Obviously, equity indices, whether it's the Russell, the NASDAQ, the S&P. There are so many great instruments and different niches that you can carve out within that, including all over the world. You can trade the Hang Seng, you can trade the FTSE, you can trade the Bund or the DAX. There are so many amazing products which have their own news catalysts and are doing different things that give you diversification of maybe setups that you're looking for or opportunities that you like to find. So that's number one. Things that are available to you is really ridiculous. Number two, the liquidity that's there. Right. I have worked at firms in the past where it is competitive to get the shares that you need. If you want to bang into 30, 40,000 shares in something, it's difficult. You have to be impeccable with your timing and reading where there's liquidity and where there's not, as you change markets or even within the same stock, just seeing it and being able to hit it when it's there. And when it's not and you need to get out, slippage is part of the cost of doing business. There's tremendous liquidity in many futures markets that would make a lot of equities traders jaw drop to realize just how large they can be and how large they can scale up their trading within that product without any concerns for slippage or anything like that. Another thing is kind of, it's twofold. It's access and it's risk management. Okay. So first and foremost, access, you don't have to sit around and twiddle your thumbs or get really clinched, if you know what I mean, about what's going on overnight, because the market is there and it's tradable all night long. Typically, their markets break for 1 hour, between like 5 and 6 p.m. So you can actually, which brings to the second point, not only access opportunities, think Brexit or presidential elections or all kinds of things, that events that happen that you want to be a part of in real time, not wait for the gap the next day, or pre-market trading or whatever. You've got access to those opportunities. And I'd say equally important, if not more important, you've got access to risk management during the overnight hours with liquidity. I know the liquidity is not as high, but it's plenty. Okay. Plenty good. If you're in a position in the S&P or crude oil or whatever, and you're trying to swing it, over multiple days or weeks or whatever, you can have a stop in place that's not just going to become an order on the open with a large gap against you, and you really can't control your risk as well. You can do that in futures. It's a big deal. And I'm not going to, another point here is I'm not going to give, tax advice, obviously. And it depends on where you are in the world. But for example, here in the States, there's tremendous tax benefits to futures. Who knows what happens with capital gains rates and things like that. But as it stands, what is it? Section 1256 contracts is kind of the technical term, to where no matter if you held a futures trade for 1 minute, 60% of those gains over the course of a year or whatever, of all those little short-term trades, doesn't matter if it's long-term, are treated as long-term capital gains. And that can be tremendous savings as opposed to what short-term trading typically brings you, which is going to be taxed at your regular income tax bracket and whatnot. So it could be some really, really big benefits depending on where you live and what your situation is. But taxes are a very big deal. Leverage is huge. It takes a lot of capital to make meaningful money in equities and a lot of different products. Futures, there's a tremendous amount of leverage. Now, leverage is a double-edged sword, right? Leverage is, it can hurt you. You can blow up accounts easier, that type of stuff. But once you learn how to take intelligent use of leverage, right? Let's say you have 100K as your trading account. As a futures trader, you do not need remotely close to take all 100K. And let's say that you were going to risk 1% per trade, right? $1,000 a trade. You do not need 100K in your futures account to take that type of risk. You can have that money in long-term investments, CDs, whatever, something where across the risk spectrum you like for that money to be based on your personal preferences and needs. And you can put in this trading capital of a smaller amount and take advantage of leverage. Your money's working for you better. It's a big deal. Going short is the same thing as going long in futures. Literally, there's no difference. There's someone on the other side of the trade that you're matched up with. That's your counterparty risk handled by the clearinghouse. You do not have to find borrows or locates to be able to short this thing that you want to short or whatever. It's all the same in futures. You just long, short. You make money if it goes up. When you're long, you make money when it goes down. When you're short, you lose money when it goes up, vice versa, right? It's a big deal, that simplicity of just that flexibility of being able to do that so easily day in and day out. So there's a lot of really, really cool benefits to futures. So we'll move on from that. I know it's a minority of people here, which is why I'm going to make it very quick, and that'll be that. But I did want to talk about the benefits of futures. There's a lot of people in the trading world right now who are here because of GameStop or are here because of crypto or whatever, and they found me, Apteros. Hey, let's learn from someone credible, and I like the way this guy talks, whatever, right? But they don't really understand futures and what that entails, right? So hopefully that's helpful to some of you. So the setup I want to talk about is oh, by the way, I did want to mention, reach out to Ryan on our team if you have any questions about futures or transitioning to futures. It can be daunting when you're trying to figure out how to trade them in terms of, I need to get a brokerage that allows it. I need to get access enabled for futures on some platforms, that type of stuff. So reach out to support@apterostrading.com if you want to learn more about that. Okay, so the reason I like this talk, like I kind of started out at the beginning, is markets evolve. Volatility comes and goes. The kind of some of the dynamics and different shorter term ways that markets are trading changes over time. There's just a lot of things that are in flux. Markets are never the same. They're always kind of changing a bit. Now, certain things tend to stand the test of time. Nothing works 100% of the time, but we have certain laws of market dynamics and things that we look at, and we're going to look at them a little bit here today. But it's really important to stay abreast, if you will, of what's working. And whether that be in a small group on a trading desk like we do, whether that be on your own in terms of what's working, what's not, in terms of daily review, weekly review, these things are important. So today is a talk about what's working. Maybe another time we'll do a talk about what's not working. I think that's equally as important. So what we're going to talk about is very simple. Now, don't sign off the webinar because I said it's going to be very simple. There is elegance in simplicity. There is robustness in simplicity. If I were to come in here today and tell you that I'm going to teach you the most complicated thing you've ever heard of, number one, because it is so detailed and granular and complicated, it's probably something that's very fleeting in its nature of working. Whereas this has been working really well as of late, but it is also something that tends to hold the test of time when there's decent value migration and movement in markets. Okay. I know some of the most advanced quants in the world, and they would tell you the same thing regarding simplicity and robustness. It's very, very important. You wouldn't believe how simple some of the profitable quantitative strategies out there are. So with that said, this setup I'm calling value migration in crude oil specifically, combined with intraday condition. So let me ask you guys one more question, a poll here before we get started. Are you an existing NADRO student or not? Let's see what our split is here. few more seconds. Okay. It's 25-75. 25% yes, 75% no. I expected the opposite of that. So I am tickled to death that this 75% of people here. Well, that's a name I haven't seen in a long time. Philippe, hope you're doing well, brother. Hope you're doing well. Philippe is old school. I can't remember if he was in our Skype room back in the day, long time ago. For sure in the Slack room. Good to see you, man. Okay, so I'm excited about the fact that there's so many of you here who haven't studied these concepts before. So let's get some share going here, and let's talk about this. It's going to be a day trading setup. It's not a swing trading setup. The tools you will need are either market or volume profile. Okay. I talk a lot about, I get asked a lot, hey, why do you use market profile? Why not volume profile? Blah, blah, blah. Isn't market profile old school and volume profile more new age and more sophisticated? I guess technically yes, but trust me, they both work. And I have some good reasons why I prefer market profile. Namely, I didn't plan for this to all come full circle here. Namely, who knows in the chat why one of my favorite things about market profile? It's a word that I've been hitting on earlier. Let's see in the chat if somebody knows. Why do I like market profile? We don't bash volume profile. Single prints, robust. Farhad got it. Simple. Simple. A volume profile will come in and it might look like this. Okay. Whereas the market profile gives you no detail. It's going to look something like this. Yes, I'm doing a screen share. Can let me know in the chat if you can see the screen. We're getting questions about not seeing the screen. Yeah. So you probably just need to click somewhere. Zoom can sometimes be a little confusing. Just click around on Zoom in your toolbar and see what you can pop up. All right. So there's a simplicity to this that some people who use volume profile, they get caught in HVN, LVN, HVN, LVN, HVN, LVN, right? Instead of just saying, oh, here's value for this day because we had a nice balance. That's one of the reasons I prefer market profile is that simplicity. Doesn't overcomplicate things a lot of times. Yeah, most of you in the chat are talking to all panelists, but you can change that to all panelists and attendees, and everyone can see what you're saying. Okay, so you'll need market profile or volume profile. Volume profile is fine. You can still look at this and see, kind of average it out in your brain, right? And a lot of times it's not that bad. You know, it might be something like there's an LV in here and then it comes up and, you know, there's something there. So, you know, you might get a little bit trapped with that, but you can still kind of average out the day, which is good simplicity. What else will we need? VWAP, which is volume. Google it if you don't know about it. Weighted average price. Okay. So if, you know, 5 contracts trade at $1 and then 10 contracts trade at, you know, $1.01, you're going to have, you know, a VWAP that's, I apologize for my stupidity here. I should have done an example that I'm smarter on. So if there's twice the amount, I'm guessing it's almost like 2/3 of the way there. Am I right here? There could be a simpler example where you had you know, 5 traded at 1 and 5 traded at 1.02, okay, the VWAP is going to be at the average, which is 1.01, volume weighted average price. If you had a ton of volume trading at 1.02, right? Let's say it was 115. Well, guess what? The VWAP is going to be up there real close to that. Okay. And it just continues to cumulatively average that over whatever periodicity, typically a full session is what we look at it on an intraday basis, which is what these setups are going to be based off of. So VWAP start plotting, and then it plots the next one, then the next one, then the next one, and it just draws a line, right? It's like a moving average, but it's volume weighted. You not only will you need VWAP, okay, but you will also need the ability for it to give you volatility-based bands, okay? So even Thinkorswim can do this. A lot of platforms can do this. So we'll need to be able to see, like, most importantly, plus and minus 1 standard deviation from the average, which is the VWAP itself, okay? So you'll have VWAP, and then you'll have an upper 1 plus 1 standard deviation, and then a minus 1. And we'll use this area as a tool to help us take some of this trade setup. Okay. One thing I want to teach you, in addition to kind of understanding the fact that we're going to use a distribution, a profile, and its value area loosely. We care more about where is this actual balance, this actual distribution, but we can look at value, which is where 70% of that trading occurred. Okay. So guess what? We're going to consider this value as well. This is going to be the prior day's session, okay, what we call PVA, which is prior value area. And this plus and minus 1 on an intraday basis is what we call our DVA, developing value area, right? So those are the two tools we're going to use. And essentially, what some of you perhaps are already grasping is that we're already bringing in the concept of multiple time frame analysis, right? We're going to look at a profile which was already put in place from, let's say, yesterday. And then within that, on a different chart, on a different time frame, we're going to look at where today's value is migrating. Is it trending, higher, lower, and where is price relative to that, right? That's what it's all about. When we're reading the contextual picture, where is price relative to value? Are we trading up here, above value? Are we trading in here, inside value? Are we trading down here, below value? There are important implications once you understand the world of profiling and auction market theory behind that. The too long didn't read version is if price is above value, that's bullish. If price is inside value, that's neutral because we're rotating around inside it. Still, nothing has changed from yesterday. But if we're breaking down outside of it, that's bearish. Pretty intuitive. What do you think has happened? I love to use car examples for some reason when I talk about this. Kulu, we can talk about value migration relative to all kinds of measures of value, of prior value. The CVA is just a higher time frame than a single day's value. We could look at where value was last year. So that's just a different time frame question. It's all the same thing. I think a lot of you probably know, we're all markets people. What's happened in the used car market? I just sold one recently for quite a bit more than you would expect. What's going on with the used car market, right? It's like a hot market. It's almost like a bubble, right? Um, so let's say that we had, it doesn't matter, a Honda minivan. Okay, what are those things called? Honda. What's the Honda minivan? Honda Odyssey. Thank you, Chris. We've got an Odyssey here. We're looking at the market for Honda Odysseys, and it's been trading in this range, right? Given that it's the same year with the same miles, right? We're looking at a specific market, a 2-year-old Honda Odyssey with less than 30,000 miles on it, right? Whatever. Well, guess what? It's kind of trading in this range between, I don't know the price of them, $30,000 to $35,000. I don't know. Okay. Well, guess what? It's building this area, which we could define as value. If we took this price info and put it into a profile. So what's happened recently? Well, guess what? That's happened. The market has changed for 3-year-old Honda Odysseys with 30,000 miles or less. We have gone up and cars are being sold at prices up here. And guess what? We're starting to see a new value area that's developing, a new balance. So that's the concept. You could apply. I love to use a market like this as an example because it gets your mind out of trading and it gets you thinking about just real life and an auction process and what's going on there. So that's important just conceptually. So we understand the tools we need. You're now understanding value a little bit. You're understanding developing value, right? If we were to not make this static, like here's last 6 months and here's the most recent 3 months, well, this could be developing where we might come in here and it might start here, values developing. It's at this point in time, but then we start trading higher, right? And developing value looks something like this over this full period. Here's the +1, here's the -1, and VWAP would be right there. So we're going to combine these things to look for a trade. So remember, the name of the trade here, the concept is value migration in crude oil combined with intraday condition. What we as NADRO people, when we talk about intraday condition, it's quite simply where price is generally spending time rotating, where price is being, not just where it's one tick above or below, relative to our developing value area for the session. Okay, so we could have a developing value area like this, and price could be rotating inside it, right? That's what we call a rotational market in terms of our intraday condition, because this is just measuring developing value for the current session. And don't worry, guys, we're going to look at some charts, okay? But I just want to teach conceptually before we get to them. What about a market that is essentially trending, right? Well, you would have your value area, and maybe it started off as rotational, and then we broke out, and we started to hold outside generally of this developing value area. Price is generally holding outside it during this period. Remember how we talked about how with prior value, if we're above that prior value, that's generally bullish. That's value migrating higher because you're going to have a developing value that starts to migrate higher than the prior value. and you're having price that is migrating higher than the current developing value, which is kind of playing catch up, trying to figure out where is value migrating to. So let's talk about kind of the four things that we might could put together for a basic NADRO trade combining prior value of any form, such as Kulu asked about. It could be a CVA, which is just a longer term composite of where value is over a bigger picture, or it could be yesterday's value area. Okay. How can we combine where we are relative to prior value with where we are relative to developing value to come up with trades? And there's really four combinations of those things generally when it comes to value migration. Here's our prior value with our value area. So this is yesterday's trade and the distribution that it formed from the open to close. So if we're trading up here, we understand that we have a bullish context. Where would that change? That would change if we fall back into prior value. Okay, so this is essentially a form of a line in the sand for our contextual read. So we're bullish from there. So we want to look for a way to get long. Here, insert developing value. So remember, developing value can be in one of two intraday conditions. We could be rotational or we can be imbalanced. So if we want to get long because context is telling us to get long, there are two ways we can use developing value to achieve that. One would be, let's say the market is rotational. So that means here's our developing value, here's our +1, here's our -1. And we are trading above prior value. Remember, this is the bullish line in the sand. So we want to continue to look for long opportunities. If we are rotational, the opportunities to get long are from the lower edge near, not at precisely, but near what we call developing value area low, 1 standard deviation below VWAP. Opportunities to get long, opportunities to get long. Ideally, we could trade from this exact contextual line in the sand because that's where we have the biggest contextual risk reward, but it doesn't have to be, right? You could easily take this trade right here from, this gap above where prior value was because it's a bullish context and you can remain bullish. Now, what we're doing today is just, it's one talk. It's a drop in the bucket of the full NADRO frameworks and understanding context and whatnot. So keep that in mind. It's extremely simplified, but extremely powerful nonetheless. So when might we not be bullish anymore? Where could we set our targets? Any of that type stuff is just beyond the scope of what we're talking about here. We're mostly focused on entries, not so much. I'll give you a couple options in terms of trade management when we look at real charts and stuff, but we're focusing on where you have an opportunity to have a contextual bias, bullish or bearish, and how to access that trade by using our intraday condition, intraday developing value. So that's number one way that we could get long in this bullish environment. What if we go imbalanced up? That is, price starts doing this. Well, guess what? As long as we remain imbalanced up, that is, price is generally holding beyond the +1, we can buy those pullbacks that generally it could dip a little below it. You could buy the pullback, right? As long as you're not spending most of the time on these rotations back inside developing value like this, right? Now all of a sudden it's game over. You can't keep buying those pullbacks long because we've had a move to rotational from imbalanced up. So as long as we're imbalanced up, you can go with that imbalance to the bullish direction because we have a bullish context and we're imbalanced up intraday. So you see, we're not required to trade a certain intraday condition when we want to be long based on what our context is telling us. We can do that in two ways. If it's a choppier day, we can fade lower extremes, as we call it, of a rotational intraday condition. Or if we get that trend day, we can go with the imbalance. So we could flip this on its head for the downside. Let's say we're trading below prior value. That would mean we're bearish unless this level is pushed back into substantially. How might we use our DVA? Well, if it's rotational, we can fade the upper extremes. If we go imbalanced with intraday DVA, we can go with these imbalance pullbacks, as we call them. Does it really work this good? Is it really this simple? The 25% of you on the call here who are current students know that it does. Is it perfect? Is it easy to have the right mental framework to not allow the last trade or two, which were losers, to affect your analysis? Or is it easy to get lost in maybe some order flow tools and things and make a decision purely based on that and forget about your bullish or bearish context? There's a lot more going on that makes trading hard. But I told a advanced group mentoring student the other day who we've kind of like gotten really back to basics, kind of like we're talking about today, the bare bone basics of NADRO here. I told him that I would not be surprised to see this trader trade the best that they've ever traded with the simplistic approach that we had kind of tasked them with doing for this coming week. Today will be day one. I haven't looked at what they've done so far, halfway through the day. But some of you, for the 25%, today might be a refresher for you on getting back to some of the basics that just work. And maybe losing some of the complexity of your process so that it is more robust, so that it is more repeatable. Getting too caught up in some of the other more complex references and things, and kind of forgetting about basic value migration and the opportunities there, combining two time frames with each of their own value areas like we're displaying here. Yi was asking, any tips if price just chops around key levels, right? So let's say, because this is the age-old question around trading, right? First and foremost, sometimes it's going to happen and it's going to throw us off and we're going to have some losses because of it, right? Hopefully, the additional filter of the intraday developing value prevents that. So let's say that we are chopping. Let's draw our developing value. I'm going to draw it in a way that allows us to get chopped in terms of the contextual reference. So there's the +1, there's the -1, okay? So what if price was doing something like this, where it holds above the contextual reference here, and then it breaks below it, and it holds there, right? And then it's back above it, like, oh my goodness, we're getting chopped above and below. Well, guess what? In this situation, you either have a choice to where this trade, let's say, for example, here, a potential long from, because remember, we have to use our DVA to access the trade. If you're generally bullish and you feel like we didn't press quite far enough into the contextual reference to violate it, you would take this trade and you would not be chopped up because you're able to be loose with all these levels. On the other hand, if the rhythm and the different things we read with NADRO and the acceptance picture is what's key, what we call it, told you that now we're bearish against this level because now we're really holding underneath the prior value area high. Well, guess what? This is not a long trade anymore. There is no trade. The only way you could get short is if developing value area high migrated down and we remained rotational, and you got a trade from the upper extreme looking to short this, which is a different trade. Yes, Aaron. Or it goes back to where we're now holding back above it, and then maybe the lower extreme is there and you can take the trade. Okay, so the number one, Yi, is that the DVA provides a filter. So when you're looking at where are we relative to prior value, number one, and then what opportunity is there in terms of long or short bias, even if we chop above and below that contextual reference, we're using our lower time frame DVA to filter out a lot of that noise. And guess what, guys? A lot of the noise comes from the middle third in between DVA, right? Let's draw it cleaner. Here's DVA. A lot of the chop comes around VWAP itself. It comes in this middle area, which guess what? I did not tell you was a trade opportunity. I said the trade from the extremes in a rotational environment or in an imbalanced environment, look for retests of value. So we don't get chopped up in this chop. Are sometimes we going to get chopped up elsewhere? Yes. But I can assure you that you will get chopped up less to the extent where being a CPT is possible, right? Because bad stuff is going to happen to all of us. Bad stuff. I use that with quotes, right? It's just part of the game in terms of getting chopped up or whatever. But if you get some sound principles like I'm teaching here around middle of, also think contextually, guys. Think contextually. Crude oil today. I said choppy here. I said I'm interested above here. I'm interested below there. That's my DMI today for crude. Middle third of a balance, middle third of DVA, avoid it. Avoid it unless there's a ridiculously good contextual reason to compromise that intraday trade location. All right, let me check my notes here. So unless we have some major questions, I think we understand the concept of prior value and developing value. Good question from Peter here. What's more important, PVA or DVA, prior value or developing? The answer is prior. Context is king. Context is king. Let's say we have this prior value and we're up here and here's DVA. Well, DVA is offering, let's say, shorts of the upper extreme. Is that a good trade? No, it's not, because we're a bullish context above there. So full NADRO traders have a lot more variables we can use. We can do stuff like this. We wouldn't take a short right into the bull reference, but up here, if there was enough risk reward down to here, it's more complicated. But for today's talk, and for all the time, context trumps anything DVA gives us. Context is the trade idea and the bias. DVA is simply a tool to access that idea. So that gives you the hierarchy right there. Would you consider a trade setup as invalid once you're stopped out, or would you consider re-entry? Do you cool off before re-entry? It's the way I'm going to teach this today, and the way that I typically trade, and the way that I teach within NADRO, is that we maximize risk reward by timing our trades on a shorter time frame. We really dial in that the stop is tighter than what context would have it be. And we look to use rhythm and order flow to time those trades very effectively within the context of narrative, within the context of DVA, right? Therefore, we will get stopped out while the trade is still technically valid. Therefore, re-entry is a mandatory component. If you don't have aggressive re-entry when warranted, you will not be consistent at trading the way that I teach it here. Now, you could have a different way of approaching it. You could use much wider stops, and therefore stops could be a true invalidation of the full contextual picture, in which case there would be no reentry. So it depends on how you want to approach it. But the way I teach it, the way I typically do it, the way we're going to talk about it today, reentry would be a requirement to trading like this. Noise happens, guys. Little stop runs happen. We're talking about day trading here. There's a lot of games, a lot of noise, a lot of randomness. So don't let a little wick out that you quickly see doesn't have any gumption behind it that's failing right back in and you're setting right back up. We put the trade right back on. Sometimes in a trending move, the first support comes at VWAP. This trade is not taken around VWAP, is avoided. My general rule of thumb to my students is that VWAP can be a trade location if and when it is perfectly confluent with the actual contextual line in the sand. Once we're away from that in open space, even if we have a directional bias, VWAP's off the table. I have different traders who have found specific ways of trading VWAP that specific markets have tendencies. So that's up to you guys as you develop a personal niche within the NADRO framework, right? It's very important. We don't just have this. It's just, there's no flexibility. There is. I teach frameworks. Do you use full session or RTH VWAP? Up to you. Up to you. I typically lean more on ETH, but RTH is perfectly acceptable. It kind of depends on your time frames and what you're looking to do and what market you're looking at. Okay. So we're not going to, Kulu, we're not going to look at that situation. I know you're a student. Ask it in the student area around NADRO DVA section. We'll cover it, but that's beyond the scope of teaching this setup here today. So we'll stay on point. Okay. What next? The formula for entry, and then we're going to get to some charts. This trade, value migration in crude oil combined with intraday condition. So this is the VMCCIC. The Vimchich. This is the Vimchich trade. Equals a bias from prior value plus a DVA setup, as we've talked about, fading edges of a rotational market, going with pullbacks in an imbalanced market, plus I'm going to make, it's two things, but I'm going to make them kind of one line item. Pullback plus momentum shift. That's our formula. It's simple, isn't it? Now, we taught you what for some of you may have been some really new concepts in order to get to the point of understanding this. But once you have that understanding, this is very simple. Okay, we understand where we are trading relative to prior value. We understand that gives us a bias. We then understand how to access that by the general two different ways you can access the trade with a DVA setup. And then finally, as we get into the kind of the nitty gritty of pulling the trigger, right? We need enough of a pullback and we need a momentum shift. Stuart asks, how do you know value migration has stopped? That is when you start to see, it depends on the time frame, okay? prior value, like value migration is going to be like this: day 1, day 2, day 3. Well, guess what? Here's day 4. Value migration has stopped. We're not migrating higher anymore. On an intraday basis, we could get imbalanced up like this, and then the imbalance fail like this and go rotational again. Value migration has stopped. So it depends on the time frame, but you could use either of these tools on any time frame you want. So this is the formula for the Vimchich, whatever I called it, trade. So how about we actually pull up some charts? How about we actually look at some of these? I'm just going to walk through. It's not a, I hate cherry-picked examples. I think that almost every, raise your hand if every webinar you've ever been to that's like this, where they talk about a setup, it's a PowerPoint presentation with the most hand-picked example of it ever of it working. Get real. Like, I know that it's okay to teach concepts that way and whatnot, but you need to see it over and over again, and you need to see it in real life, a little messier, a little sloppier, and whatnot. So let's pull it up. All right, so here I have a market profile chart. Each one of these little clusters represents a day. Each one of these letters, A, B, C, D, represents 30 minutes. Just for those of you who are unaware. And here, my friends, is an example of a developing value area chart. Where this kind of hard to see blue, let me change the color. What do you say? This light gray area is the plus and minus 1. So the reddish line is VWAP itself. The shaded region goes from the +1 standard deviation down to the -1 standard deviation. We have a setup that's occurred here today, which we'll get to as we go through. Chris, ping us on the technical aspects of the math and the calculation. It is the variance method. Chris must be a smart guy. Join us, Chris. Join us at Apteros. Bring your brains. All right, so what I want to do is just go through July. This is a Sierra chart. Don't let their archaic website fool you. This is the most flexible and powerful platform at the lowest cost that exists on the planet. There is a learning curve. They will tell you that you're an idiot via their support sometimes when you ask a question rather than helping you. But beyond that, our whole desk uses it. That's what we use. Our desk, you can use whatever charting and analytics you like, but our desk uses Sierra chart. All right, so what I want to do, we got crude oil pulled up here. We have our profiles. We have our DVA. I want to just go through July. Okay. Exactly, Aaron. They're brutally honest, but they know their stuff. They are first and foremost, programmers, rather than blowing smoke and trying to sell you something. They're focused on their product, and their product is good. All right, enough. So as the shaded region is extended hours, right? The pre-market, the post-market, that type thing. The pure black section is what we call the pit session for crude oil, which is from 9 a.m. Eastern to 2:30 p.m. Eastern. Okay. So see my crosshair here. This point at the open on July 1st of this year is this point on July 1st on the profile. Where are we coming into the open on July 1st in terms of value migration? Imbalanced up. That's correct. We are imbalanced up. Here was prior value, right? And today we are, as you can see from the overnight session, right? We were already trending higher. So there were opportunities in the overnight session, including this beauty, which we'll talk about, which occurred just before the pit session opened. My TPOs are pit session only, 9 a.m., as you can see on the time scale here, until the close at 14:29:59. So value migration's higher. We're bullish. There's two ways which we could then go from this context. As long as we're holding above this level, we could then go over to this chart and find ways of getting involved. We could trade pullbacks as long as we're imbalanced up, as we were for those of you, trading at 7 a.m., trading at 8:45 a.m. Eastern. And these are little micro ones here, right? Very, very quick. This is a 3-minute chart. What if we were to go to a lower time frame, right? I know a lot of people are using stuff like 250 volume chart in crude oil here. So here we are after the open. You see the setup. I'll scrunch it so you can see all of DVA, right? All right. What about the pre-market? Now, remember, let's go through the formula. We have our bias set by value migration, where we are relative to prior value. We're above, so we're bullish. DVA is giving us currently, and we'll just go back to the 3-minute chart because we're just going to keep it, little simpler. DVA is giving us what we call an imbalanced pullback, because what's the intraday condition? Are we holding inside of DVA? No, we're above it starting at, 6:30 in the morning, which, by the way, was one of the retests of the breakout from prior value, right? Here is prior value high. So we went right up to it, found sellers, and then we broke out right here at 3 in the morning. And there's the very first imbalance pullback. There's the second one, nice little flaggy pattern. Then we actually went rotational during this phase, so there was no trades. And then we go imbalanced again, and there's this one, and there's these two smaller ones if you're looking at a smaller time frame. If you're trading a 3-minute chart, this is not a pullback, which let's continue getting to our formula here, talking about this. So we have our bias from prior value. We have our DVA setups, which we're just looking at, a handful of them, right? Next in the formula is it's just 3 things: the pullback and the Momo. Pullback is something that there's a big art to understanding pullback, and you combine it with science. Momentum shift is very easy, so we're not going to get into the depths of understanding pullbacks. I can tell you that on a 3-minute chart, this one little down bar that we talked about is not a pullback, right? So it needs a couple of bars, let's say 4 or something, right, before it becomes substantial. So this one's really just like a 2-bar pullback as well. Again, those are not great pullbacks on a 3-minute chart. This one's great. This one's great. Right? So you need enough of a pullback just based on what kind of volatility are we seeing, right? If we're seeing rotations about this big, well, look for a pullback about that big. If you're seeing rotations this big, well, look for a pullback about that big. There's a whole, it's our concept of rhythm, and everything we teach around understanding the current rhythm dictates how much of a pullback we're looking for and whatnot. And then what do we need? We need a momentum shift. How can you find a momentum shift? You could do the little trend lines like I'm doing and look at where that momentum changes, right? You can use an indicator like stochastics that get down and start to turn up, RSI that gets down and starts to turn up, MACD that changes slope, Z score. I mean, there's a million things that you could use to give you an indication of, okay, we've pulled back an acceptable amount, and okay, momentum is shifting in our favor now. Bang in, market order, don't dilly-dally around. Now's the time when the risk reward is at your favor and other participants are pushing things in your favor. So this was just July 1st. Let's keep going. We'll go through, a little quicker. I'd like to get a lot of examples in and maybe not spend as much time on. So this is interesting. July 2nd. Where are we opening on July 2nd? You see where my horizontal cursor is for this day, July 2nd? Where are we opening relative to prior value? Inside. There's smart guy Chris again. Inside. Okay, there's prior value. So let's map these over. Where is prior value? The low edge is here. The upper edge is here. Did we have value migration on this day? No, we did not. We had this one small probe, which could potentially give us a beautiful trade if we'd been able to hold below there and get a momentum shift and start to turn. But it didn't happen. And spoiler alert, this is a really good trade here and here because we failed to get imbalanced. We failed to leave prior value. We're rotational both contextually and intraday. Based on what I've taught you today, I think you already probably understand that setup. And that's not even the setup I'm here to teach you today, but it's a beautiful thing. Let's move along. Let's delete these. Following session, we open above prior value. Okay, so prior value is here, prior value high, right, from the profile here. Here's where we're opening, just above it. We get back inside it. Okay, so nothing for us to do. And then boom, news comes out. On a 3-minute chart, this doesn't look like a pullback, but you guys know what it's going to look like. If I go to a volume-based chart, it's going to look like a beautiful 8-bar pullback to give us our trade. Yi, you sound like a student asking about, acceptance and whatnot. That's a little beyond the scope of today's talk. Just like we can't define, the detailed talk around rhythm and everything. Ask it in the community forum. More than happy to help however we can. You got a whole community around you that can help with that. So, I mean, we here's prior value again. Don't lose sight. Like it's just a line, but remember, it's not just a line. It's this, right? From here. Okay. So here we are, potentially, bullish above here. Here we are, potentially not bullish. Boom, clearly bullish. So now we have our bias to the upside. Now we have DVA giving us what we need. And we have a pullback if you're using a volume-based chart or something a little bit lower time frame than this 3-minute chart. And the momentum shift, no matter how you want to define it. At a certain point, we go from heading down to heading up. Okay, so somewhere right in there is where you have the momentum shift, depending on the tool you use to define that, or however you eyeball it. I'm all for as discretionary as you want to be, as long as you're going through a checklist like this and saying, I've got these things that I need, and I'm applying my read to each of them. That's a beautiful way to be process driven, yet discretionary. It's a great way to trade. More examples. Let's keep going. We're not picking out days here to be perfect. We are looking at day after day. All right, this day. Okay, so prior value was here. Okay, the distribution is like this, right? So prior value, we break down, we're bearish below it, get short, potentially get short, and then it ran out of time. It didn't go any lower there. No, just look at this, guys. Look at this. You leave the prior day's profile, you get all this upward movement. You stay, you open inside, you stay, and you build more balance in the same spot. You open here, you balance a bit, and when you decide to really leave, you get movement higher. Guess what? This was a trap of the entire market. So now you got a little bit of value here. You've got all this value from the prior several days, right? You break it down. Guess what? You get all this movement. Over and over and over again. Pay attention to simple value migration where we attempt it and fail, where we attempt it and going with it while it is currently what is. We trade what is with NADRO. Not what we think should happen, not what we wish would happen, but what is. And we stay objective about that. And our mental framework and the work we do on that is very important to allowing our minds to do that. We're not even going to get through the full month here because we're running out of time, but let's keep looking. All right, here's the day where we open back in prior value. This one's complicated because we've kind of got two distributions. It's not a very, it's not a nice looking profile. See how this one's just a beautiful, beautiful, not much here, a little here, right? So it's a little complicated, but we can certainly look at this distribution, this lower distribution, right? And so where is that? Here is the upper end. Here is the lower end. So we break below it, and then there's our first trade. Hope I'm not going too fast with these. I hope you're understanding. There's the distribution from the prior day. We get a bias once it breaks down. We get a DVA setup off developing value area low. Now, is this one that works out beautifully and just trends for another $3 in crude oil? No, it's not. But it's a trade where you probably get in around 62 cents. It goes all the way to 21 cents, which is a lot. 40 cents is no joke in crude for a scalp. So you're probably taking some partial profits here. It looks like the sellers just ran out of gas here, and that was all she wrote. And then we go rotational. The one thing that I have used and may use in the future, I'm not currently using it. Peter asks, do you use any indicator to enter the pullbacks like you mentioned? The only thing that I've used, and I'm so glad you asked this, I should have said, I have used, not currently using, nothing against it. I'm just kind of, I can see it with my eyes. Heiken Ashi. Japanese, Tokyo Olympics, Heikinashi. We can start our own Heikinashi Olympics for momentum shifts. So it's just simple. It colors the bars based on kind of a smoothing formula rather than the bar is green if it closes one tick above where it opens, right? Or red if it closes one tick below where it opens. It looks at where the average high-low close of the prior bar and average of the current bar, things like that. So it smooths out the shifts in color, AKA the shifts in meaningful momentum shifts. So that's something that I've used. And that's something I teach to use. Okay. I mean, let's find a loser. Come on, let's find something that sucks. Okay, so where are we opening here? It is inside of prior value, right? We're looking at this day, the 8th, compared to, we got a nice distribution here. So let's mark where that is. Upper end is here. Lower end was, here. Notice I tightened up my read of value. That's a little bit of an advanced topic, which I'm not going to talk about today. It's beyond the scope. But do you think the value is here up beyond where any of that distribution is here? Do you think the value is here? It's because of the first half of the day, right? If I were to split this profile and change it, it would tighten up. And I already know that, so I just did that. So we're inside, we're rotational intraday. Boom. This is the first little break and hold of intraday, but we're still inside of prior value. So there's nothing for us to do yet. The trade's not there. Guess what? Now it breaks prior value and we're imbalanced intraday, so you can trade these pullbacks. Beautiful day. All right, I would love to get a horrible example to show you how you can lose money doing this. Okay, a gap up day, which just holds imbalance and then kind of fizzles out into the close. Let's just skip it. Here's a day where we are gapping down relative to prior value. So there's not much for us to do here. Obviously, it's rotational intraday, right? We're inside of DVA. And the bearish line in the sand is right here. So technically, you could have taken, this one doesn't quite get there. And this is what we call a faux. So it's not ideal. This or this or this would be places to short a rotational market rather than an imbalanced intraday market, going with the value migration lower, the imbalance lower contextually. So this is a different example that I think that we've seen so far. So let's make sure you see it. So prior value low is here. Prior value high is here. So let me just draw it. It's a profile that looked like this. So we're bearish below prior value. We are rotational inside our DVA. Therefore, we can fade the upper extreme. 1R, guys, is child's play. 1R is absolutely baby land. It's nothing. You should if you're scalping this trade, right? We can have a stop somewhere above these swing highs, pretty tight, right? Whether or not you took it there, whether or not you took it there, whether or not you took it there. And so we're talking about, let's say you got in there, right? We're talking about 2 to 1, just like into VWAP. And this is not a trade that worked out in any meaningful way. It's just a trade where we pretty much got one rotation, and it was all she wrote. We ramped back into the close. That's 2 to 1, just on the small rotation. You can scalp single rotations doing this for 2 to 1. You can do a lot more when you put it all together with the full NADRO methodology, with the full top-down analysis, with a full understanding of order flow. You can do a lot more in terms of risk reward. All right, guys, we've gone over here in terms of time. So I just want to again reiterate, this is a just tiny slice of what NADRO is all about. I'm so glad that it was 75% of you on the call here that we could help to understand some of these concepts, how simple they can be. Trading, you do not have to overcomplicate trading. We were able to teach you in an hour some simple ways to frame context, some simple ways to access ideas, some simple ways to look at a shift in momentum to pull the trigger. I didn't talk a lot about trade management because I think that it's just, I wanted to focus on the entry here today. That's what I wanted to give you. So join our community, become a student, hang out with us, learn, grow, develop, go through the failures together, celebrate our successes together. That's what we're all about. So again, cheers, guys. We'll see you around.